Hello, everyone. Today on the final bar, we're going to hit our normal Friday routine, which is focusing on Wrap the Week, where we take a step back, look at this week's trading now that we've locked in Friday's close and see how it lines up with the long-term trends. What long-term conclusions can we draw from the market environment this week? Also, we're going to answer your questions from the final bar mailbag about identifying support and resistance levels, some overlays on the charts, and also just the nature of this uptrend, Fed buying, how to see some of those things on charts, and lots more. Ladies and gentlemen, this is the final bar. Hello, everyone. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Welcome to the final bar. Appreciate you joining us every weekday after the close as we break down the action of today. On Fridays, we love to break down the action of the entire week and start to draw some conclusions from what we've seen. And for me, this show ends up being the beginning of sort of a weekly routine for me, digesting the action of the week, starting to look at top-down, bottom-up perspectives. And then on Monday, we'll take a look at the markets from a couple different angles and see how we're positioned for the coming week. You know, overall, plenty of distribution today. And after yesterday's sort of rally into the close, the question was that a bounce before a continuation higher? Today, certainly resolving more to the downside with the S&P finishing near the lows of the day. So we're going to have to look about what this means for the long-term charts. A lot of it's funny. It doesn't take much for a chart that looks really pretty attractive to look a little more negative. As I was talking with Greg Gunther, my guest yesterday. So we'll take a look at some of the charts and how they've played out today. Just coming up on the final bar and on StockCharts TV, we have such great guests that we love to bring on to get their perspectives in front of you, help you understand how they're approaching this really unprecedented market environment. On Monday, on our next episode of Behind the Charts, we have Sam Stovall from CFRA Research in New York. I've known Sam for a number of years. He's a strategist. He is not a technical analyst. And it's really cool to hear how he approaches things and how technical analysis, how price action fits into his overall picture, his view of the world. Coming up on the final bar, we have a couple great guests here. On Tuesday, Samantha LeDuc. On Wednesday, Jonathan Krinsky. And on Thursday, Clint Cowell. So some really good repeat guests that have done a really, really good job on the show. So excited to have him back on. And then coming up after that, the week after, on May 13th, is our next episode of The Pitch. This will be hosted by Grayson Rose here at StockCharts, and he's going to moderate a conversation with three strategists sharing some of their picks for the coming week. So it should be a really interesting discussion. Don't forget that on May 13th. Let's get to our market recap. And as I'm thinking of market activity today, and as we've talked with each of my guests this week, you know, where do you see things headed from here after we've had this huge run? We had the 30+% sell-off, a 30+% gain after that, you know, retracing almost 2/3 of the way back up from that February to March sell-off. You know, what now? I feel like at this point, everyone has somehow been validated. Unless you were short at the lows, most people, after selling off 30%, expected some sort of rally, right? And I think, you know, if you expected a bear market rally, you've had it, right? I mean, this has been it. And the question is, are we at the end of it? If you're more long-term bullish, it's a question of, you know, could we continue higher from here? Could we continue to build on this momentum? And so let's look at some of the charts today, how they played out and how today's down close maybe gives us some color on those long-term perspectives. So the S&P 500 closing down around 2830. This is almost a 3% sell-off from yesterday's close, really gap down in the morning and sold off. Most of that was in the morning for 1 p.m. Eastern. NASDAQ down a little more, about 3.2%. Mid caps and small caps down the most. So certainly a risk-off move. Just looking at today's trading, and the VIX back up to just under 37 at the close. If we look at a daily chart of the S&P 500, you know, again, if you had perfect foresight, you might have drawn this with a crayon of a rally after a huge sell-off. Once you saw the March sell-off, and it's where do we go from here? And as we rallied a little bit, I certainly didn't at the time expect we would have this big of a move. I mean, it's been the severity of the sell-off was matched only by the severity, the rapid gain that we had since the bottom on March 23rd. But if you look at where we've been since then, where we've gotten to, we topped out just above 29.50, around 29.60, 29.70 or so. This is right at a confluence of resistance that I've highlighted with the orange bar here. So we're right above the 61.8% retracement. That's at 29.35. That's retracing 61.8% of the way February to March. So boy, if you're a Fibonacci fan, this could end up being the ultimate example of the benefit of using Fibonacci retracements, seeing how we retraced so beautifully. We traded right above that level, but the next day, yesterday, closed back below, and then today obviously down to a new low for the week. We're also right below the 200-day moving average, which is right around 3,005. So this 29.50 to 3,000 level is a confluence of resistance from a number of different places, and sort of all lining up in that similar place. And again, what sort of, to me, validates this bear market rally thesis, which I still think is pretty valid, is the fact that the RSI topped out right at 60. And again, that is pretty classic for a bear market phase, that you'll have rallies that bring you back to an RSI of about 60. They don't get near the overbought range because there's not enough momentum to push it higher. And that's where things sort of peter out. So if we would sell off dramatically from here in the next couple of weeks, this will line up beautifully with a classic bear market rally phase, and something that sucks so many investors in to the long side. Let's look at some of the other charts and see where we're playing out. Bonds actually finishing stronger today, with the TLT closing almost at the highs for the day, up 0.9% to 168. And looking at commodities, gold was really the only one finishing in the black. Gold was up 0.6% to with the GLD just below 160. Most other commodity-oriented ETFs lower, with the DBC, which is a good sort of overall commodity benchmark, down 1.25%. In terms of sector moves, and when we get to the 3 and 3, I picked a couple sectors because I think they're at really fascinating points right now. The top two sectors were consumer staples and communication services. So the XLP finishing number 1, that has not happened in a while. It's still down over 1%, but down the least out of the 11 sectors. On the downside, you have energy leading the way, lower, down 6%. Followed by consumer discretionary, followed by financials. You know, we talked a lot about financials as they appeared to recover, right? You sort of had this new swing high, testing this resistance level, breaking back above the 50-day for the first time since late February. And all of a sudden, look how we've reversed very quickly. So that resistance level right there for the XLF, just around 2370 or so, seems pretty meaningful. And a lot of charts are seeing this sort of double top pattern for the month of April starting to evolve, given the sell-off that we had toward the end of the week here. And so starting to become more significant of a resistance level to really watch out for if and when we would rally, maybe going into next week. But the XLF all of a sudden now rotating back below trend lines. If you take it from the lows, we're just starting to penetrate those to the downside. You had a lot of movement with equities, and we don't have time to go through all the different themes to note. So I just wanted to highlight some of the industry movements that we had, and then we'll get to our next segment, wrap the week. Number one stocks today were gold stocks and other miners. Those are both up 2.5% or so, followed by insurance brokers and then trucking. Those are the only 4 out of about 100 odd Dow industry groups that we track that finished in the positive today. Everything else was negative, but things that were down less than the market were big pharma, home improvement retailers, something like a Home Depot and others. So there were some groups that finished okay, finished weaker, but not materially weaker. Now, what actually drove things down is a lot of consumer discretionary. So we'll see recreational services, autos, gambling, all within consumer discretionary. The airlines got beaten down, energy stocks. So these have been some of the stocks that were part of that recovery story, coming up so quickly out of the lows. Now, all of a sudden, just like that, sort of returning back down. So there was this huge bid that came in at the beginning of this week, which felt like all right, this is now people buying the beaten down names, expecting them to rally. But all of a sudden the week ends and it feels more like a consolidation. It's less like airlines are going to take off and more that they are continuing to back and fill around this range with the, from the lows and the highs that we established in late March to early April. So, again, a week that started to feel like the next, stepping on the accelerator going higher. I think as you're making sense of things, and we're going to get to our next segment here momentarily, Now, I think you have to question how much of a validation this week maybe was. Maybe it was more of a validation of backing and filling, if not the next leg down in some sort of bear market experience. That's our market recap for today. I want to go on right on to our next segment, wrap the week. So every Friday, we like to take a look at how this week's activity has affected the long-term charts, try to make sense of things. We want to start with a poll. So we always have polls running on the StockCharts TV page on our website. Also on our YouTube channel, we'll circulate some polls. So make sure you subscribe there and you'll get all the notifications. We asked you what will happen before the end of this year. Option 1, the S&P 500 breaks above the February high around 3,400. Option 2, the S&P 500 breaks below the March low around 2,200. Option 3, neither will happen before the end of the year. And the number one answer was the last one. Although, to be honest, there wasn't a huge spread between these three. There wasn't a clear outlier, but the number one, the most popular answer was neither will happen. Essentially, we'll be range bound between the February high and the March low. And looking at the chart, that's, I mean, a pretty decent case. I put a video on my YouTube channel today about the three directions of the market. The market can go up, it can go down, it can go sideways. That's this poll question actually inspired that video. And I see your point, 40% of you that say this is a huge range now, and you could see us spending some time sort of filling in this range. And even Craig Johnson from Piper Jaffray on the show this week, who is very bullish, expecting the S&P to reach 3,600 by year end. Still expected more of a sideways trend for a little bit before we would resume the uptrend. So I think that's justifiable. A third of you, though, suggesting we will break above the February high before the end of the year, and 27% of you, 1 in 4, just over that, expect us to break to new lows. So what's interesting about how you responded is there's a pretty wide spread. There's a decent, meaningful amount of you on each of those three different responses. So we will have to see which one of these, how things play out. I wish I could tell you what the right answer is going to be. All I can do is show you the charts and try to answer them with you together. Having said that, let's continue our process of wrapping the week by looking at the Mindful Investor live chart list. We do this every week. It's also part of my weekend routine. If you've not looked at this before, it's no problem. Click on the articles page on StockCharts on the right. You'll see all StockCharts blogs. Go to my homepage here, which is the Mindful Investor, and then you'll see live chart list at the top. That'll take you right to this thing, and you can actually access it at any point. I customize, I tweak it over time, but usually relatively stable list of charts. So we're going to start with sort of my long-term market trend model, and this combines 3 time frames. The PPO, the weekly PPO based on long-term moving averages, the 21 and 34-week exponential moving averages is number 1. And if that's above 0, it's bullish. Below 0, it's bearish. It turned bearish in mid-March, remains that way. And again, that's part of the reason why I've talked about a bear market rally a number of times, is because of that remaining in a position of negative trend. The medium trend for me is looking at the weekly PPO using the traditional 12 and 26 week read, and then a 9-week signal, which is the red line here. That turned negative mid-February, has remained negative. Although the rally in the last month has certainly pushed this closer and closer to a buy signal, has not happened yet. So it remains on that medium trend, being weaker rather than stronger. The short term, the tactical trend for me is looking at the change in the histogram of the MACD. You can see that turned positive here at the end of March and has remained positive, sort of matching this short-term uptrend. So again, for me, it's less of a predictive model in general. It's more of establishing where we're at and making sure I start my process with a good long-term, medium-term, short-term perspective. So for my read, it's still long-term bearish, medium-term bearish, short-term bullish, and that's about how the market has felt to me looking at the chart subjectively. Looking at the daily chart, again, we talked about this earlier in our market recap. I think what's key is we've reached that 61.8% level. We are right below the 200-day moving average, which has been relatively flat around 3,000. So I think at this point, most people feel validated. I've talked about a bear market rally. I feel pretty good about this being a potential ending point for it. If we would break above 3,000, I would have to completely turn on that and say we're going to go to previous highs, if not further, because that's enough momentum. But at this point, I'm seeing the market fail at resistance with an RSI that did not get above 60, and that is characteristic of a bear market, the end of a bear market rally, to be honest. Now, on that short-term tactical time frame, our next chart is looking at the cumulative advanced decline lines on the S&P, the NYSE, the New York Stock Exchange, the mid-cap universe, and the small-cap universe. You can see all 4 of those making higher highs and higher lows along with the market. So as long as that pattern continues, I think you have to feel pretty good about a continued short-term, that tactical time frame, the short-term time frame, couple days to a couple weeks continues to be positive. If we start to get lower lows, lower highs in those readings, and this is not updated quite yet for today, we'll have to see how far it goes down. We start to get these breaking through the swing low from a week and a half ago. I think that'll be pretty telling. This chart, new highs and new lows, often looks a lot more interesting. It really hasn't been because it's been so flat. So many stocks, just like the market, are in a huge range from their 52-week high and 52-week low. So besides that handful of names making new highs and that handful of stocks near their lows, pretty much everything is mid-range. And so this is really flattened out, remains that way. If you would start to see in a sustained uptrend, we started to see more and more S&P names making new highs. That's sort of come off a little bit of things have retraced back into that range. So looking for that to increase would certainly validate more of a bullish thesis. In one of the ultimate bonehead strategist mistakes, I tweeted out an outdated chart of this next one, and I feel horrible about it. It was definitely not intentional, but hopefully a reminder to myself and others that I am imperfect, which I don't need reminding of that too often. But if you look at what has happened, over 70%, almost 76, 77, 8%, something like that, of the S&P 500 in about a month have gone from no stocks above their 50-day to almost 80% of the S&P above their 50-day. That was in 3 to 4 weeks, which is huge, right? That's a huge swing, and it's an unprecedented swing, but not completely unprecedented. And again, thinking of how this fits into previous sell-offs. If you look at late 2008, you had that same sort of sell-off, then rally with 0 up to 80%, and that's a lot like what we've seen right here. And so looking at that in particular, it's starting to look a little bit more like late 2008. The number of stocks above their 200-day was totally different, though, because stocks had been in a downtrend, remember. So 2007 to 2008 was a downtrend of almost a year before you had the big sell-off. This has been very different. We came right off of the highs and rotated lower. So it doesn't have a perfect historical precedent, but an interesting one. I've had a lot of questions about the AAII rankings, the sentiment rankings from the American Association of Individual Investors. I would remind you all, it's a piece of anecdotal evidence that I use. I've not found it to be statistically meaningful if you look at all of the indications. But for me, there's value in looking at survey data, just like there's value in looking at investment themes that pop up on major publications. We used to use Time Magazine and things like that. But now, looking at The Economist and seeing what sort of themes come out there, because that usually plays off the underlying sentiment. That's where the masses are positioned. And the AAII ratings, with all of their faults, I think still have some interest to me, some intellectual interest, looking at how those sentiment readings have changed. And it's worth noting, we were at an extreme negative signal last week with 50% of respondents bearish. That's come back up to 44, and you've seen an increase in bullish respondents. So from last week to this week, you had a huge distribution, a huge negative swing that's now kind of come back to mid-range. So for me, that volatility in the voting suggests sort of the volatility that we've seen in terms of the uncertainty that we've seen in the markets as a whole. We need to take a quick commercial break, folks. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. Appreciate you joining us every weekday to try and make sense of the charts, try to understand how this market is evolving real time using the charts of the day. Today, we're going to answer questions from the Final Bar mailbag. As a reminder, just shoot us an email, thefinalbar@StockCharts.com. Nothing is out of bounds. Ask whatever you like, and we'll pick some of those questions and answer them live on the show. I'll try to get to 3 of them here today. We'll see how that goes. Question number 1, and I love this because it is right to the point. Please explain how 90% of the experts predicted a W bottom, but we actually got a V bottom. What do you think went wrong with the experts? I love that question. And I will tell you, one of the most humbling things I have ever tried to do is send an outlook out to more than one person and put yourself out there with an opinion. It is not easy, and I will tell you right, if you start that expecting to be right all the time, you're going to be wrong so much more than you'd ever want to be. Having said that, your question is very fair. And I would say this, right? We certainly have had this appearance of a V bottom, and from what I've seen, a lot of victory laps of people thinking, okay, that was not a bear market rally. This is a new bull market. The Fed is going to come in and support anything we need. How could the market? And I've literally had people answer questions on YouTube and elsewhere. How could the market go down? And for me, my spidey sense starts tingling when I hear people saying the market cannot go down. And I immediately expect what we've seen at the end of this week was the market, in fact, going down a little bit. So if you think that the market is unable to go the opposite direction, that's usually the signal that it's going to happen pretty quickly. And so I think right now, as I mentioned earlier, I think right now everyone can feel pretty confident that what they've said is right. It's totally justifiable to see this move out of the lows and think that things are just going to keep continuing to get better, and that may actually be right. And I would say as long as higher highs and higher lows keep happening, the trend is higher, and that's why I keep trying to remind everyone that. Again, the price will tell you what's happening, and higher highs and higher lows are an uptrend. That is not an opinion, that is fact. And as long as that pattern continues, by definition, you're not going down, right? So don't worry about it so much. When we start to break to new lows, when we start to establish lower highs, that's when you need to question, the uptrend. And that's why here in early March, when you had a lower high and a lower low and a lower high, that tells you can continue. You're now in a downtrend, and until you see the opposite, the trend is down. Having said that, I think if you were a long-term bearish, you could feel pretty confident that we're right at that point. If you look back at the late 1920s, if you look at any major sell-off, you always have that first big puking out of optimism. This, we're going to go to zero, and then you have this bear market rally. It sucks everyone in. It makes you feel really good that was a V bottom, and just that's pretty much when the music stops and things start to get worse. And again, I'm not guaranteeing that's going to happen, but certainly if I'm a historian, and to answer your questions, I think most experts are market historians to some degree. We have to look at what's happened historically, and that is the historical playbook for a bear market. Is a big rally like this, and you hit about this point and you start going lower. So we will see how the market actually plays out, but that's how I would answer that question. Question number two, the biggest driver I see of this market run-up is the Fed buying high-yield ETFs. That type of backstop has to provide equity buyers with great confidence. They seem to have thrown all the rules out the window. I don't know how to show that on a chart, but if you could illustrate it, that would be telling. I'm not sure how to show it on the chart either, to be honest with you, but I will show you a chart of the high-yield ETF. HYG is the way that I tend to look at it. What you're talking about, the Fed came out and talked about, really implied they could do anything to buoy the market. One of the things they talk about is buying high-yield ETFs. This was in early April, first week or two, right? And so you have this huge gap higher with the HYG, as it seems like there's this incredible, endless bid to buy more of this. And as a way of, and again, high yield, if you're not familiar with it, high yield debt is basically corporate debt written by or issued by companies that are higher yield, meaning higher risk, or sort of junk bonds, right? Companies that are less credit worthy, not the big blue chips, but more speculative names, and they have to issue debt at a less favorable rate because they're less favorable of an issuer. So basically the Fed saying they're going to jump in and do it. That's how it looks on the chart. I think what's interesting is the fact that that's the highest point it's been. And since then, the HYG has arguably been in a downtrend of lower highs and lower lows. So it sort of shows you there's that initial reaction to that announcement. But if you look at how expectations have evolved since then, it's sort of gotten less and less positive, in particular on the HYG. Now, having said that, how do you track that? I don't know if there's a great way to literally show that. You can look at flows in ETFs, which certainly would be one way to do it, but there's no way of attributing who's doing the buying or selling. It's more just tracking flows into different places. I think the chart and looking at the supply and demand aggregated in the form of the price is the best way to do it. And again, your point of the Fed stepping in and being a buyer of last resort is totally fair, and that's come up with a number of my guests over the last couple of weeks, either explicitly or implicitly, based on what we've talked about this demand that will continue to move assets higher. But that is how I would start to think of that question. Again, a lot of people that are very bullish on the market are using that as one of their key bullet points to the argument, and I get it. I see it. The challenge, and just to finish with that, not to get too deep into a strategy discussion, I think that the challenge is any historical reference you use for that to validate that argument is different. We haven't seen it happen with these particular conditions, with this particular structure. We don't know what the impact of all of that is going to be until we see what the price does. Final question: how can one find support and resistance levels on a stock using indicators or overlays instead of annotating? That's actually a really decent question. I was messing around with the volume at price earlier, which might be one way I would think of it. So, is there some way to automate support and resistance levels? We don't really have an auto support and resistance feature, and if there is one somewhere, I'd recommend you not using that, because for me, support and resistance is part of your analysis, part of your chart analysis is by doing it. That's honestly why this show is called The Final Bar, because whenever I've taught technical analysis, I always say start with the final bar, start with the current bar, and look to the left. And that's where you identify key support and resistance levels. And the first levels you come to that are, peaks and valleys in the prices that stick out one way or the other are the ones you want to pay attention to. Guys like, Tom DeMark come to mind. They have automated ways. He has a TD lines indicator that is automated based on certain highs and lows. So there are ways to try to automate it, but I have never found those to be incredibly meaningful. I'd much rather use my own level. So ways you can try and validate it, two ideas that come to mind besides just looking to the left, starting at the final bar, looking to the left. Looking at volume at price, and you set that as one of your overlays here. You set the number of histograms that you want to, the number of bars, number of segments. And what it does is it shows you how much time we've spent in each of these different areas. And what it does is it'll be extreme at places where we've spent the most time. So a lot of times that you could expect more support or resistance level, more meaning there, because we've spent more time where that's where buyers and sellers have made trades before. The other thing, and then we're out of time and unfortunately I have to move on. There's an indicator called the zigzag indicator, which automates peaks and valleys by looking at percent moves and sort of highlighting where they're at. If you're not familiar with that, you can overlay them on the price here. Just click on zigzag, and if you're not familiar with, look at our Chart School article on it. It'll explain how it works. We basically can say a 3% move makes it an indication, and it'll basically simplify the price into wave counts that are very easy to pick off. So those are two ways I might use to try and simplify it a little bit. But in the end, I'm not going to tell you to automate it, because I don't see that being your best option ever. That's our mailbag for today. And again, those are 3 questions coming to us via email over the last 24 hours. Thank you guys so much for sending those in, and please keep them coming. I'm happy to answer any questions as best as I can. We need to wrap up the show. I am told in my ear very quickly, and we are doing it right now. The 3 and 3 starts with consumer discretionary. I think what's interesting here, we talked about the broader S&P approaching the 200-day moving average at the 3,000 level. If you look at the consumer discretionary ETF, the XLY, you can see that it's already reached its 200-day and so far has failed. We had a gap down today on the XLY. Yesterday was a bit of a pullback, and it felt like, could this just be the next breath before we go further? Today, I think, makes it feel like some of those levels are more meaningful resistance. It makes them more important. And if and when the XLY can get above that 200-day, I think you have to question the bear market rally thesis at all, and just consider this is a market that's going to continue to go to new highs and complete a V bottom that's looked pretty interesting so far. Consumer staples, interestingly, have already put in a lower high. The XLY is coming off a higher high, and so it's not really established a downtrend, but the XLP has actually come down and then made a lower high, and now as of today made a lower low. So it not just failed at its 200-day, but now is in a short-term downtrend with the relative strength underperforming. And a lot of those are some of those coronavirus plays that have come down so quickly now. Finally, we have utilities. I would remind everyone, one of the worst things you can do is have a market decision, right? I think the market's going lower, for example, and then make a sector bet based on that. So utilities should do well because it's defense and pays a decent dividend. Actually, this week, in the last couple of weeks, utilities, even given a market that's now rolled over a little, utilities are selling off as well. So you actually have the relative defense of utilities weakening on a price basis and on a relative basis. So make sure you look at those sector charts. And ladies and gentlemen, that's our show, and that's a wrap for this week on The Final Bar. Thanks for joining us every weekday to break down the charts of the day. Thanks for all your questions. Keep them coming. The Final Bar at StockCharts.com, or look us up on Twitter at FinalBarSCTV. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. Be safe. We'll see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.